Imagine standing on $13 trillion and starving to death. Not metaphorically, literally. Beneath the tropical mud of the Orinoco River Basin in Venezuela lies a geological formation so vast, so saturated with hydrocarbons, that it makes the world's entire above-ground gold supply look almost modest. 303.2 billion barrels of proven oil reserves, the largest concentration of petroleum on planet Earth, not in the deserts of Saudi Arabia, not beneath the permafrost of Russia, here, in a nation where over half the population lives in poverty. This is January 2026. 7 days ago, the United States military conducted precision strikes on Venezuelan infrastructure. The stated objective, national security. The unstated objective, that thick, black substance that civilization runs on. We are conditioned to believe that gold is the ultimate safe haven asset, the bedrock of monetary security. Kings hoarded it, central banks vault it. Investors flee to it when currencies collapse. And yes, all the gold ever mined, sitting in vaults from Fort Knox to the Bank of England to private safes in Zurich, is worth approximately $30 trillion at current market valuations. But beneath Venezuela's soil lies something fundamentally different. Not a store of value, a source of power. $13 trillion in crude oil at current pricing in a single country. To understand why American carrier strike groups are now patrolling the Caribbean, why China has extended $60 billion in loans that may never be repaid, why a nation blessed with unimaginable resource wealth has an inflation rate of 172%, you need to understand one thing: the difference between owning an asset and being able to monetize it. Today, we decode the paradox. Why having the world's largest oil reserves doesn't make you rich. Why the chemistry of heavy crude determines the fate of nations, and why, in the calculus of empire, energy will always trump treasure. This is the geopolitical paradox of the 21st century. Welcome to Economy Decoded. Part 1. The valuation math, the paper wealth. Let's start with the numbers, because in macroeconomics, precision matters. According to the 2025 OPEC Annual Statistical Bulletin, the most authoritative source for hydrocarbon accounting, Venezuela maintains proven oil reserves of 303.221 billion barrels. This figure represents 17 to 18% of all proven oil reserves on Earth. For context, Saudi Arabia, the nation most synonymous with oil wealth, holds approximately 258 billion barrels. Venezuela has more. Now, here's where it gets interesting. That word proven. In petroleum geology, proven reserves means oil that can be extracted with reasonable certainty under current economic and operating conditions. This is not speculative. This is not hopeful exploration. According to industry standards, these are barrels that geological surveys, seismic data, and drilling history confirm are there, underground, waiting. But let's talk about value, because reserves mean nothing without price. Venezuela's flagship export crude is called Mare 16. It's a heavy, sour blend, terms we'll unpack in detail shortly, and as of January 8th, 2026, it trades at a discount to Brent crude, the global benchmark. Brent closed at $60.08 per barrel. Venezuelan Mare, due to its quality and political risk, trades at a $13 to $21 discount. Let's use $43 per barrel as our midpoint calculation. 303 billion barrels times $43, $13 trillion. Let me put that in perspective. The total market capitalization of all above ground gold, every ring, every coin, every bar sitting in every vault and central bank on Earth, is approximately $27.8 to $31.4 trillion. So yes, global gold is worth more in aggregate. But here's the distinction. Gold is distributed, dispersed across nations, institutions, and private hands. Venezuela's oil is concentrated. One nation, one geological basin, $13 trillion in a single sovereign territory. Compare that to the United States national debt, $36 trillion. Venezuela is sitting on an asset that, on paper, could retire more than 1/3 of American federal obligations. On paper, this is where the paradox crystallizes, because while Venezuela theoretically controls $13 trillion of underground wealth, the actual economic reality is catastrophic. Let me show you the contrast. Inflation rate in Venezuela as of April 2025, 172%. The International Monetary Fund projects This will exceed 600% by the end of 2026. 600%. Your money loses more than 80% of its purchasing power in a single year. GDP per capita in Venezuela, $4,121. For comparison, the average American earns $76,000 per year. The average Saudi, given their oil wealth, earns approximately $31,000. Venezuela, with the most oil, earns $4,000, and the poverty rate. This is perhaps the most damning statistic. According to the Economy survey from 2023, the most comprehensive socioeconomic study conducted in Venezuela, 51.9% of the population lives below the poverty line, more than half, in the richest oil nation on earth. Some estimates push this number higher, closer to 90% when accounting for multidimensional poverty, indices that measure access to healthcare, education, and basic infrastructure. This is the resource curse in its most extreme, most tragic form. A nation with more oil than Saudi Arabia, more reserves than Russia, more underground wealth than entire continents, and its people are starving. So the question that drives this entire analysis, the question that explains military interventions and geopolitical chess games and why tankers are being seized in international waters, is this: how can you be sitting on $13 trillion and be poor? The answer is not simple. It's not corruption alone, though that plays a role. It's not socialism alone, though ideology matters. It's not even sanctions alone, though those are crippling. The answer is chemistry. Part 2. The chemistry trap. The dirty reality. Here's what they don't teach you in economics classes. Not all oil is created equal. When most people think of crude oil, they imagine the images from old Texas wells, black liquid gushing from the ground, flowing freely, easy to capture and refine. That's light, sweet crude, the kind that built the Rockefeller fortune, the kind that flows. What sits beneath Venezuela's Orinoco Belt is something entirely different. Let me introduce you to API gravity. This is the petroleum industry's measurement system for crude oil density, established by the American Petroleum Institute. It's an inverse scale, meaning the higher the number, the lighter and more valuable the oil. Water has an API gravity of 10. Anything above 10 floats, anything below 10 sinks. Saudi Arabian light crude, the gold standard of easy to refine petroleum, has an API gravity of 33 degrees. It's light. It flows through pipelines with minimal pumping. It can be refined into gasoline with relatively simple distillation processes. This is why Saudi Arabia became wealthy while having smaller reserves than Venezuela. Venezuelan Orinoco crude, unblended, has an API gravity of 8 to 10 degrees. 8 to 10. It is essentially tar, thick, viscous, semi-solid at room temperature. The density is approximately 1,000 kilograms per cubic meter, nearly twice as heavy as conventional crude oil. It doesn't flow, it oozes. In winter temperatures, it can solidify completely, and it gets worse. Sulfur content. The term sour in oil markets refers to sulfur concentration. Sweet crude has low sulfur, easy on refining equipment, produces cleaner fuels. Sour crude is corrosive, requires expensive desulfurization, damages infrastructure. Saudi light, less than 0.5% sulfur. Sweet. Venezuelan heavy, 2.5 to 3.4% sulfur by weight. Extremely sour. This combination, extreme heaviness and high sulfur, means that Venezuela's oil is chemically hostile to standard refining infrastructure. Most refineries on Earth cannot process it. The molecules are too long, too complex, too contaminated. You can't just pump this into a pipeline and ship it to market. Which brings us to the single biggest constraint on Venezuela's oil wealth, the diluent problem. Here's the technical reality. To move Venezuelan crude through a pipeline, you need to blend it with lighter hydrocarbons. This is called dilution. The required ratio is approximately 60% heavy crude to 40% light diluent. 40%. Almost half of what you're pumping isn't even the oil you're trying to sell. It's the chemical thinner you need just to make the oil move. What do they use as diluent? Primarily naphtha, a light, volatile hydrocarbon that can be mixed with the tar-like Orinoco crude to reduce viscosity enough for pipeline transport. They also use condensates and lighter domestic crude varieties like Mesa, which has an API gravity of 30 degrees. Here's the geopolitical trap. Venezuela doesn't produce enough naphtha domestically. They have to import it. And historically, their primary supplier was the United States. Let that sink in for a moment. Venezuela has the largest oil reserves on Earth. but they need to import American petroleum products just to extract their own oil. When U.S. sanctions tightened in 2017, then again in 2025 under the current administration, access to naphtha imports was severed. Venezuela was forced to rely on scarce domestic supplies and limited imports from allies like Iran and Russia. According to current industry analysis, without adequate diluent supplies, Venezuelan production could collapse to 200,000 barrels per day by the second quarter of 2026. 200,000 barrels per day from a nation with 300 billion barrels in the ground. It would be like owning a $1 trillion diamond mine but not being able to afford shovels. Now, let's talk about break-even pricing. In the oil industry, this is the price per barrel at which production becomes economically viable. Below this price, you're losing money on every barrel you extract. Saudi Arabia's break-even, $10 to $20 per barrel. Their oil is so easy to extract, so light, so accessible, that they can profit even in severe price downturns. Venezuela's break-even, according to Ristad, energy estimates adjusted for inflation and infrastructure decay, $42 to $56 per barrel. That's 4 to 5 times higher than Saudi Arabia, for oil that sells at a discount. Remember our merry pricing from earlier? $43 per barrel at midpoint. That's barely at break-even. And that's assuming infrastructure is functional, assuming you have diluent, assuming you have skilled labor and operational refineries and intact pipelines. Venezuela has none of these assumptions. Let me walk you through the infrastructure collapse. Current production as of November 2025, 1.14 million barrels per day. But here's the critical detail. Venezuela's oil facilities were designed to produce at much higher capacity. Current operations run at 30 to 40% of designed capacity. 30 to 40%? Why? Chronic underinvestment since the nationalization of the oil industry in the early 2000s. When the Venezuelan government took control of PDVSA, the state oil company, from private operators, they prioritized political loyalty over technical expertise. Engineers fled. Maintenance budgets were diverted to social programs. Equipment that should have been replaced every decade has been running for 30 years. Pipelines are corroded. Refineries are obsolete. There are currently 11 million barrels of Venezuelan crude stranded on tankers in the Caribbean because the infrastructure to offload, process, and export it has broken down. 11 million barrels, floating, waiting, depreciating. This is the dirty reality beneath the $13 trillion valuation. It's not liquid wealth. It's a solid block of tar that requires billions of dollars in capital investment, specialized chemical inputs, and geopolitical cooperation just to begin moving. And here's the final technical barrier. Even if you solve the diluent problem, even if you rebuild the infrastructure, even if you get the oil flowing, you still need someone who can refine it. Most refineries can't. They're built for light, sweet crude. The molecular chains are wrong. The sulfur content would destroy their equipment. There are only a handful of refineries on Earth designed to handle Venezuelan heavy, sour crude at scale, and most of them are in the United States Gulf Coast. Part 3. The geopolitical chessboard, the why. This is where the story stops being about chemistry and starts being about empire. The United States Gulf Coast hosts some of the most sophisticated refining infrastructure on the planet. These are not simple distillation facilities. These are complex refineries, multi-billion-dollar industrial complexes designed specifically to process heavy, sour crude and convert it into high-value products like diesel fuel, jet fuel, and petrochemicals. Why were they built this way? Because in the 1980s and 90s, American refiners made a calculated bet. They invested in coking units, hydrotreaters, and catalytic crackers, technologies that can break down long hydrocarbon chains and remove sulfur. This allowed them to purchase cheaper, lower-quality crude from Venezuela, Mexico, and Canada, and still produce premium refined products. It was brilliant economics. Buy the cheap, difficult oil that other refiners couldn't handle, process it with advanced technology, sell the output at market rates. The margin was the profit. But here's the structural dependency that bet created. Those refineries now need heavy crude to operate efficiently. You cannot just feed them light, sweet crude from Texas shale and expect the same output. The chemistry doesn't work. Light crude from American shale fields has an API gravity of 40 to 50 degrees. It's almost like a different substance. When you refine light crude, you get more gasoline, more naphtha, fewer heavy products. But the American economy, and especially the American military, runs on diesel. Trucks run on diesel. Trains run on diesel. Naval vessels run on marine diesel and heavy fuel oil. Fighter jets run on kerosene-based jet fuel, which is chemically closer to diesel than gasoline. You cannot make sufficient quantities of diesel from light shale oil without expensive refinery reconfiguration that would cost billions and take years. So U.S. Gulf Coast refineries need heavy crude. They were designed for it, optimized for it. And for decades, Venezuela supplied it. At peak production in the late 1990s, Venezuela was exporting more than 1.5 million barrels per day to the United States. As of December 2025, that number had fallen to 117,000 barrels per day. What happened? Sanctions. General License 44, which had allowed limited Venezuelan oil imports, expired in 2024. Sanctions were fully reimposed. Chevron, the last major American company operating in Venezuela, was granted a temporary exemption to continue limited operations through 2025. In late 2025, even that exemption was tightened to the point where Chevron announced its exit. Then came the naval blockade. U.S. military assets in the Caribbean have seized tankers carrying Venezuelan crude, imposed de facto export restrictions, and created what amounts to a maritime quarantine. Venezuelan exports to the United States collapsed from 250,000 barrels per day in December to 117,000 by April 2025. Now here's the geopolitical irony. The U.S. could replace Venezuelan heavy crude with Canadian heavy crude from the Alberta oil sands. Canada produces similar heavy sour crude. The chemistry is compatible. But there's a problem. Pipeline capacity. The infrastructure to move sufficient volumes of Canadian crude to U.S. Gulf Coast refineries is constrained. The Keystone XL pipeline, which would have dramatically increased capacity, was canceled. Existing pipelines are running at maximum capacity, so U.S. refiners face a choice: pay premium prices for limited Canadian supply, or find a way to access Venezuelan crude. This is why, despite the rhetoric, despite the sanctions, despite the political theater, the U.S. has maintained strategic interest in Venezuelan oil. It's not about the total volume. It's about refinery optimization. It's about diesel supply chains. It's about maintaining industrial capacity. But there's another player in this game, one that has been far more patient, far more strategic, and far more willing to accept political risk in exchange for energy security: China. Between 2007 and 2025, the Chinese government extended an estimated $50 to $60 billion in loans to Venezuela. These were not conventional loans. These were oil for loan deals, a specific financial structure that has reshaped Venezuela's sovereignty. Here's how it works. China provides upfront cash to Venezuela, billions of dollars to fund government operations, infrastructure projects, social programs. In exchange, Venezuela agrees to repay the loan, not in currency, but in future oil shipments. The repayment terms are locked in at predetermined volumes and pricing, often at a $10 to $15 per barrel discount below market rates. This structure creates what analysts call politically encumbered oil. Even if Venezuela increases production, even if global prices rise, even if sanctions lift, 30 to 40% of their current output is already contractually obligated to Chinese state-owned companies. The oil is spoken for before it even leaves the ground. Russia has employed a similar strategy. Approximately $17 billion in Russian loans, plus joint ventures between Rosneft and PDVSA, Venezuela's state oil company. These deals give Russian firms equity stakes in Venezuelan oil fields and preferential access to production. So when you hear that Venezuela has the largest oil reserves on Earth, you need to understand they don't fully control those reserves. The asset is there. The sovereignty is compromised. China's strategic planning here has been remarkable. While the United States imposed sanctions and withdrew investment, China quietly secured long-term energy supply agreements. According to Mukesh Sadeh, founder and CEO of Exanalysts, speaking on January 5th, 2026, China has probably planned a lot better in terms of stopping the barrels. Stopping the barrels, meaning ensuring that Venezuelan oil, even if production increases, flows to Shanghai, not Houston. This is 21st century resource competition, not military conquest, financial encirclement, and it raises a crucial question about asset valuation. If Venezuela's oil is contractually obligated to creditors at below market prices, if production is constrained by infrastructure collapse, if the political instability makes long-term investment impossible, is it really worth $13 trillion? Or is it a stranded asset? technically valuable, practically inaccessible. The January 3rd military strikes by the United States need to be understood in this context. The stated justification was national security, degrading Venezuelan military capabilities, targeting alleged narco-trafficking infrastructure. But the strategic calculation is transparent: prevent further consolidation of Chinese and Russian control over Western Hemisphere energy resources. Venezuela is not Iraq. The U.S. is not seeking occupation. What it seeks is destabilization sufficient to prevent Venezuela from becoming a reliable energy supplier to American adversaries. If Venezuelan oil cannot flow to China, if the infrastructure remains degraded, if political chaos prevents long-term contracts from being fulfilled, then China's $60 billion investment fails to achieve its strategic objective. This is the geopolitical chessboard. The United States doesn't need to control Venezuelan oil. It just needs to ensure no one else can. Part 4. Asset class war. Gold versus oil. Now we need to address the fundamental question that ties this entire analysis together. In a world of competing strategic assets, what actually matters? Gold has been humanity's store of value for 5,000 years. It doesn't corrode. It doesn't decay. It can be divided, melted, reformed, and transported. Central banks hold 8,133 tons of it in the United States alone. At current market prices of approximately $4,500 per ounce, that's $520 billion in American gold reserves. But gold is fundamentally a static asset. It sits, it waits, it preserves. You cannot run an economy on gold. You cannot power a factory with gold. You cannot fuel a naval carrier strike group with gold bars. Gold is insurance. It's the asset you hold when everything else fails. It maintains purchasing power across currency collapses, regime changes, and economic catastrophes. This is why nations hoard it. This is why it comprises approximately 10% of central bank reserves globally. Gold is the ultimate defensive asset. Oil is something entirely different. Oil is not a store of value. It's a flow of power. Every single barrel of crude oil contains approximately 5.8 million British thermal units of energy. That energy can be converted into motion, into heat, into electricity, into the molecular feedstocks for plastics, pharmaceuticals, fertilizers, and 10,000 other industrial products. Oil doesn't sit in a vault. It moves through civilization like blood through a body. Without it, economies don't just decline, they cease to function. Transportation stops, agriculture collapses, supply chains disintegrate. The modern world runs on approximately 100 million barrels of oil per day, every day, without interruption. This is the distinction. Gold is a noun, oil is a verb. Let me give you the comparative data. The United States Strategic Petroleum Reserve, the emergency oil stockpile designed to cushion against supply disruptions, currently holds 395.3 million barrels. At $60 per barrel, that's a market value of approximately $23.7 billion. Compare that to U.S. gold reserves, $520 billion. Gold is worth 22 times more. But here's the critical question. In a crisis, which asset has operational utility? The Strategic Petroleum Reserve represents 47 days of U.S. petroleum imports at current consumption rates. 47 days. That's how long America could sustain itself if every foreign oil supply was severed. 47 days of continued economic function, 47 days of military operations, 47 days of keeping trucks moving, planes flying, and factories operating. The gold reserves? In a supply crisis, they represent 0 days of operational capability. Gold cannot fuel a single tank, cannot power a single aircraft, cannot move a single container ship. Gold preserves wealth, oil projects power. This is why the phrase gold-backed currency is economically meaningful but strategically limited. A gold-backed dollar tells the world your currency has intrinsic value. An oil-secured economy tells the world you can sustain industrial civilization. Let's run the World War III scenario, not as fear-mongering, but as strategic analysis. In a protracted great power conflict, United States versus China, conventional weapons, extended campaign, what determines victory? It's not gold reserves, it's logistics. And logistics runs on diesel fuel. An American aircraft carrier consumes approximately 300,000 gallons of fuel per day when operating at normal tempo. That's about 7,000 barrels, one carrier per day. The U.S. Navy operates 11 carrier strike groups. In wartime operations, fuel consumption across the fleet, carriers, destroyers, supply ships, submarines, would exceed 500,000 barrels per day. At maximum withdrawal rates, the Strategic Petroleum Reserve can release 4.4 million barrels per day. That volume could simultaneously fuel the entire U.S. Navy, provide diesel for ground forces, supply jet fuel for air operations, and maintain critical domestic transportation and agriculture. The gold at Fort Knox could fund the purchase of fuel, assuming global oil markets remain functional. But if those markets are disrupted, if supply chains are severed, if adversaries control production, gold becomes irrelevant. You cannot eat gold. You cannot fly a fighter jet on gold. You cannot generate electricity from gold, and this is the hard calculus of power. In peacetime, gold is the prudent hedge. In wartime, oil is the existential necessity. Now apply this logic to Venezuela. 303 billion barrels. If Venezuela could produce even 3 million barrels per day, a fraction of their potential capacity, that would represent 1.09 trillion barrels over a century of production. At current prices, that's $47 trillion in cumulative revenue. $47 trillion. But it's not about the revenue. It's about the leverage. A nation that controls significant oil production can do more than sell it. They can withhold it. They can direct it to allies and deny it to adversaries. They can use energy exports as a weapon, not through military force, but through market manipulation. This is what Russia demonstrated in Europe. Natural gas supplies to Germany weren't just commerce, they were leverage. When geopolitical tensions rose, the implicit threat was clear: cross us, and your industries freeze. Venezuela's oil, if fully developed, would represent that same category of leverage. Not for Venezuela itself. The nation lacks the state capacity to wield that weapon effectively. But for whoever controls access to Venezuelan oil. If China secures long-term contracts for Venezuelan heavy crude, they reduce dependence on Middle Eastern supplies that transit through U.S.-controlled shipping lanes. That's strategic depth. If the United States prevents Venezuelan oil from reaching China, they maintain choke point control over Chinese energy security. That's strategic denial. The oil itself is almost secondary. What matters is who can access it, who can deny it, and who controls the infrastructure that makes it flow. Gold can be moved, hidden, divided. It's fungible and portable. Oil is geological. It exists where the reservoirs formed 300 million years ago. You cannot move it without extracting it. You cannot extract it without infrastructure. You cannot build infrastructure without political stability. This is why oil-rich nations that lack state capacity become targets. Not for invasion and occupation, that's expensive and politically untenable, but for influence operations, sanctions regimes, proxy conflicts, and economic warfare designed to ensure that strategic resources flow to preferred customers. Venezuela is the case study. The oil is there. The value is real. But the state has collapsed. And in that vacuum, great powers compete not to own the oil, but to prevent rivals from controlling it. There's a term for this in geopolitical theory: strategic resource interdiction. You don't need to acquire the asset yourself. You just need to ensure your adversary cannot acquire it either. Keep it locked in the ground. Keep the infrastructure degraded. Keep the political situation unstable enough that long-term contracts cannot be honored. From a cold strategic perspective, a destabilized Venezuela serves U.S. interests more effectively than a stabilized Venezuela serving Chinese interests. The same calculus applies in reverse. Chinese loans to Venezuela, even if they're never fully repaid, serve strategic purposes. They create dependency. They establish precedent for resource-backed financing. They signal to other resource-rich nations that Beijing offers an alternative to Western-dominated financial institutions. Gold doesn't enable these strategies. Gold is defensive, passive. It waits for crises. Oil is offensive, active. It powers the machinery that creates crises or prevents them. In the final analysis, here's the distinction. A nation with gold reserves can survive economic collapse. They have a store of value to rebuild from. A nation with oil reserves, or more precisely, a nation with access to oil reserves, can prevent collapse in the first place. Gold is the parachute. Oil is the engine. And in a world where great powers are competing for technological dominance, industrial capacity, and military superiority, you need engines, not parachutes. This is why Venezuela's 303 billion barrels matter more than the metal in Fort Knox. Not because the oil is worth more in dollar terms, it isn't, but because the oil can be converted into power projection, economic leverage, and strategic autonomy in ways that gold simply cannot. The question has never been whether Venezuela is rich. The question has always been, who gets to convert that richness into power? Part 5. Conclusion. The final verdict. Let's trace the timeline, because the pattern is instructive. 2017. The Trump administration imposes comprehensive sanctions on Venezuela, blocking PDVSA from accessing international financing. The explicit goal is to pressure the Maduro regime. The implicit effect is to crater Venezuelan oil production. Output begins a steep, accelerating decline. 2019. Major power grid collapse across Venezuela. Not a natural disaster. Infrastructure failure from decades of underinvestment. Oil production facilities go offline. Pumping stations fail. Production falls below 1 million barrels per day for the first time in decades. 2020. The COVID pandemic creates global demand destruction for oil. Prices collapse. But in Venezuela, there's a small reprieve. Chevron receives a limited operating license from the U.S. government. The justification is humanitarian, but the effect is strategic. Keep at least minimal production flowing to prevent total state collapse and potential refugee crisis. Production stabilizes at around 400,000 barrels per day. 2022. Russia invades Ukraine. Global energy markets convulse. Europe scrambles to replace Russian natural gas. Oil prices spike. Suddenly, Venezuelan crude looks more attractive to Western buyers. The Biden administration signals potential sanctions relief. Venezuela offers to increase supply. But here's the problem. They lack the capacity. Years of infrastructure decay cannot be reversed in months. 2025, new administration, hardline return, sanctions tightened beyond previous levels, naval blockade established in the Caribbean. The Murray discount widens to $21 below Brent. Chinese tankers are seized. Russian shipping companies are sanctioned. The message is unambiguous. Venezuelan oil will not reach geopolitical rivals. January 3rd, 2026, U.S. military strikes on Venezuelan infrastructure. And here we are. The expert assessment from Mukesh Sadeh, the CEO who analyzes global oil flows for institutional investors, is particularly revealing. His statement on January 5th carries weight precisely because it contradicts the optimistic narratives. There has been a lot of hot talk and wrong analysis on the significance of Venezuela's oil reserves, he said. Then the crucial observation: at that very high price of $150 per barrel in 2008, they proved they have a lot more oil. These are paper reserves. Paper reserves. The oil is there. The geology is confirmed. But the economic viability is theoretical. At $150 per barrel, with functional infrastructure and political stability, yes, those reserves are worth extracting. At $60 per barrel, with corroded pipelines, no access to diluents, international sanctions, and a collapsed state, those reserves might as well be on Mars. They're geologically real, but economically stranded. And perhaps that's the point. Perhaps the strategic calculation is that Venezuelan oil should remain stranded. Because of Venezuela producing 3 million barrels per day of heavy crude, selling to China at negotiated prices would fundamentally alter the balance of energy security in the Pacific theater. Better to keep it in the ground, better to maintain just enough production to prevent total state collapse, because that would create humanitarian catastrophe and refugee flows, but not enough to become a reliable supplier to American adversaries. This is the paradox we've decoded today. Venezuela's oil is more valuable than gold, not because of its dollar price, but because of its strategic implications. Gold is an asset class. Oil is a weapon system. Gold preserves wealth within an existing order. Oil determines whether that order continues or collapses. In the game of empires, gold is how you keep score. But energy? Energy is how you play the game. A nation can lose its gold reserves and survive. It happened to France in World War I. It happened to Britain in World War II. They depleted their gold to purchase weapons, supplies, and alliances. They survived. But show me a nation that lost access to energy and survived as a modern industrial power. You can't, because it's never happened. Energy loss equals civilizational collapse, always, without exception. This is why American carrier groups patrol the Caribbean. This is why Chinese state banks extend loans that will never be repaid. This is why tankers are seized and infrastructure is bombed and sanctions are imposed and lifted and reimposed in cycles. It's not about helping the Venezuelan people. It's not about democracy promotion or humanitarian intervention. Those may be secondary considerations, but they're not the driving force. The driving force is the recognition that whoever controls energy flows controls the future. Venezuela doesn't control its own energy. The infrastructure is too degraded. The state capacity is too limited. The debt is too crushing. The oil is too heavy. But that 303 billion barrels sits there, waiting. Potential energy, in the most literal sense, and the great powers circle, not to extract it, not yet, but to ensure that when it is finally extracted, whether that is 5 years from now or 50, it flows in the right direction. Gold sits in vaults and waits for crisis. Oil prevents the crisis or prosecutes it. That's the difference. That's why Venezuela's reserves matter more than Fort Knox. That's why a poor nation with oil is more strategically significant than a wealthy nation with gold. In the 21st century, energy is not just a commodity, it's the substrate of power itself. Welcome to Economy Decoded. This has been the $13 trillion paradox. The oil is there. The question has always been, who gets to use it? And that question will shape the next decade of geopolitical competition. If you want to understand the world, stop watching the headlines. Start tracking the tankers. Because where the oil flows, power follows. Thank you for watching.